Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me to share the results of the fourth annual Trust Barometer Special Report is Josh Hochberg, General Manager of Financial Communications at Edelman. Josh, it's great to see you. Welcome back to Trade Talks.
It's nice to be here. Thanks for having me.
And this year, Edelman surveyed 600 institutional investors across 6 countries, representing firms that collectively manage over $20 trillion in assets on pivotal issues shaping investment criteria and corporate behaviors driving investor trust. So, Josh, let's discuss the key findings. How was ESG investing approached during COVID-19? The results surprised me a bit.
Yeah, I think what we've seen this year and really over the past 2 years is that ESG principles are driving investment decisions in very meaningful ways. Several interesting points to consider here. And again, 600 institutional investors, 90% of the respondents agree that one, their firms invest in companies that have reduced their near-term return on capital in order to reallocate capital to ESG initiatives. Two, a company with strong ESG performance deserves a premium valuation to its share price. And 3, companies that prioritize ESG initiatives represent better opportunities for long-term returns than companies that don't.
Are companies prepared for the resurgence of shareholder activism once the economy recovers?
Yeah, so it's an interesting question because heading into the survey, what we wanted to determine was that if shareholder activism, especially public campaigns and proxy fights, would be well received during the pandemic. And what we learned from our survey was that 9 out of 10 investors actually believe and agree that it's okay for activist investors to initiate a public campaign during the current market environment, and that as we recover from the pandemic, there will be an increase in shareholder activism. One would imagine that this would come as a result of potential dislocations in valuations, or from the company's mismanagement amidst the current market environment, or a combination of both. Whatever the case, it's clear that activism will remain prevalent. And very interestingly, investors agree that companies aren't ready for it. As a matter of fact, 85% of investors surveyed said that most companies are not prepared to handle activism campaigns.
Did the respondents believe that businesses must lead on societal change?
No question. We found that social matters more than ever. And as a matter of fact, social has now climbed to the top in terms of ESG priorities for US investors. This compares to number 3 last year. Importantly, what we saw were some high marks for the importance of corporate behavioral practices like maintaining a healthy corporate culture, prioritizing employee safety and health, and in this market environment, unfortunately, communicating transparently and compassionately around furloughs and layoffs, and then of course, diversity and inclusion. There's absolute expectation from investors that companies will act on these topics and that they'll engage management teams on these issues. And interestingly, that there will be board level focus and intent and attention.
And Josh, did the respondents think that strong D&I practices impact trust and ultimately the share price?
Yeah, what's interesting is that not only is D&I important, but investors are holding companies accountable to disclose what they're doing, and then they need to back that by detail and data. 63% of investors in the US agree that disclosing employee diversity and inclusion statistics impact trust in a company a great deal. This is up 11 points over last year, and that's not surprising. And now we're seeing D&I tied specifically to valuation. 92% of investors in the US strongly agree that strong D&I metrics have a positive impact on a company's share price. As a matter of fact, Nasdaq's announcements today in terms of D&I inclusion at the board level shows how much interest there are in these issues.
And finally, how did this data overall compare to last year's results before COVID-19 was even a part of our vocabulary?
Yeah. So as we were formulating this survey, we asked ourselves if investors believe that a focus on ESG is in fact a luxury, especially given all the other issues that companies are dealing with over the course of the pandemic. And while we found that 79% of US investors say that their firm is currently deprioritizing ESG as an investment criteria, given the impact of the pandemic on the economy, the longer-term focus on it remains steadfast. As we recover from the pandemic, 93% of US investors expect that companies they invest in to increase their prioritization of ESG initiatives. And very importantly, 95% of US investors strongly agree that a company with strong ESG performance is more resilient in a crisis, which means that investors believe that those companies that focus on ESG will manage better through our current situation, as well as other crises as they come along.
All right, Josh, great to catch up with you as always. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thanks, Jill.